In partnership, in this class, we are going to deal with the death of a partner. Running financial year 1/4/2025 ends on 31st March 2026. Suddenly, what happens, on 1/1/2026, one of the partners expired, deceased. Now, how can we now settle the dues for him to the legal estate of deceased partner? You understand? For this period, just similar to the retirement, you can calculate all. So, you prepare the revaluation account and the capital account and all, distribute all the accumulated profits and losses up to this date as per the retirement process. So, what happens? The deceased partner's estate will get capital, reserves and surplus to the deceased partner's extent transferable, revaluation, profit and loss will be adjusted, goodwill will be added to the retiring partner. All these things usually you do know at the time of retiring. Similarly, you do this up to 1/4/2025. In the current year, he was in the business up to this period, 1/1/2026. Up to this period, he was with the business almost 9 months. Now, for the 9 months, there may be some earnings. No, now we have to pay this amount to him. Usually, to get the profit, to identify the profit, you have to prepare the final accounts, trading and P&L account. By preparing the P&L account, you will get the net profit. That net profit is transferred to the P&L appropriation account, and later it is transferred to the partner's capital account. But we don't usually prepare the final accounts on 1st January 2026. As on the date of death, usually we don't prepare the final accounts because it's a hectic job. Demised, and immediately we cannot prepare the final accounts to find out what is the profit as on the date of death. Then we calculate the profit and loss for this period based on the previous year profit, previous year's base for calculating the profit. For example, in the last 3 previous years, the average profit being 12,000 rupees per month. We expect the same 12,000 rupees could be earnable here. Is that okay? Same 12,000 rupees. For the 9 months, if time proportionate is applied, then 9,000 may be assumed profit. In that 9,000, now we have to calculate and give only for the deceased partner's estate. Others partner never bother about that. Is an only estimation, it's not real one. Based on the previous year or previous year's average profit, either simple average profit or weighted average profit, whatever it may be, we usually calculate the average profits for the goodwill calculations. Goodwill is nothing but the future earnability of the company. Future earning power is determined based on the previous year's profit. We usually take the 3 or 4 years profit base, average profit of the 3 or 4 years as the base for calculating the future year's profit. Similarly, before 1/4/2025, whatever the profit take the average of that. So use that average for calculating the profit for the current period. And from 1/4/2025 to 1/1/2026, you have to calculate roughly what could be the profit. In that profit, you have to calculate the profit for the deceased partner's estate and add that with him. Okay, deceased partners and other partners. For the other partners, we will not add. We do all these things, but for the other partners, we don't add. Because it's our requirement to settle only for the deceased partner's estate. For example, this deceased partner is eligible for 1/3 profit. So out of the 9,000 rupees estimated for the period of his survival with our business, in that 1/3, 3,000 will be payable to him. So 3,000 is credited to partner's capital account. 3,000 credited to partner's capital account. All these things are credited. Capital, accumulated profits and losses, revaluation profits and losses, goodwill. All these things are taken there. Now, what about the 3,000? Okay. What about the 3,000? 3,000 is just now calculated and will be payable to them, right? How? To deceased partners capital account. Deceased partners capital account. Debit the P&L suspense account is a temporary account. It is a temporary account. 3,000 rupees. That's how we can calculate estimated profit during the year of death up to the date of death. The entry being P&L suspense account debit to deceased partners capital account. That's how you can pass the entry. Then you prepare the P&L appropriation account, trading and P&L account, and then you prepare the P&L appropriation account. You prepare the P&L appropriation. In that P&L appropriation account, you transfer the net profit identified. The net profit may be 15,000, 10,000, not necessarily the 12,000. This is only estimation. The actual profit may be say 15,000. If the actual profit being 15,000 in that year, in that this amount will be adjusted first of all, P&L suspense account. Balance 12,000 will be now shared to the continuing partner. Is that clear? Up to the date of death, you have to estimate the profit is meant for the deceased partner's estate and transfer only to his capital account. While transferring to his capital account, the amount is going to be charged to the P&L suspense account because we are not preparing the P&L appropriation account by the time. So temporarily, we will keep that amount in the P&L suspense account debit to deceased partner's capital account. Is that clear? This P&L suspense account appears in the balance sheet until the final account is prepared. Thereafter, this P&L suspense account is closed by transferring to the P&L appropriation account. So the deceased partner's share is already given. For the remaining continuing partners will get this 12,000 rupees. Step number 1. In case of death, you have to understand this one first of all. Step number 2. The second point to be understood here is the money will not be settled immediately. Immediately after the death, the deceased partners will expect to release his share of capital. But it is really not possible to release the huge capital invested in the business. Is that okay? So they usually continuing partners will demand for late settlement, not immediately. If the amount payable to the deceased partners is delayed, maybe payable later on, then for the delayed settlement, the deceased partner's estate will demand some return. How can we settle the return? See if there is a deed available for this. Okay, in case of delayed settlement, what could be the compensation payable by the firm to the partner? If that information is given in the deed, you just go with the deed. If that information is silent, okay, if deed is silent, okay, then you have to depend on Partnership Act. Already you know that in case of no P&L ratio, actually you have to refer the Partnership Act. By referring the Partnership Act, you will share the profits and losses to the partners equally. Similarly, in case of delayed settlement, how the payee is compensated is missing, then automatically you have to go and refer Partnership Act, especially Section 37. Section 37 says whichever is higher of or as per the choice of deceased partner's estate, you can give one of the two things. Choice means, do you want to get 1 lakh or do you want to get 2 lakhs? Definitely your choice is always higher, right? That's why I use the term whichever is higher. As per the choice of the deceased partner's estate, we have to make the payment. The choice being 1. 6% interest on the unsettled money. 6% interest on the unsettled money. Whatever the amount you calculated supposed to be payable, remains unpaid. The deceased partner demands, sir, so much money is lying in your business itself without giving to me. No problem, sir. I will pay 6% interest there. Or, is there any other option? Yes, of course. Profit earned using his capital. Profit earned using his unsettled, unpaid money, which is nothing but capital ratio. You find out the balance before the settlement date. Goodwill should be addable to all the partners. All these things are addable. Only raising the goodwill is done. Cancellation is not done. Raising the goodwill, after raising capital, resource and surplus, revaluation, profits and losses and goodwill to all the partners. After that, whatever the balance you have That will be the base for distributing this profit to the partners. This profit to the partners. Is that clear? In that, his share will be using the capital share, profit into capital contribution of the partner and total capital of the entire firm. That's how you can calculate. Hope you'll be now able to understand these cases. Death of your partner. So journal entry to transfer deceased partner share of profits up to the date of death. Profit and loss expense account to deceased partner's capital account. Section 37, delay in settlement to the deceased partner's estate. If you are delaying to pay it and deed is silent, maximum of these two. One is interest at the rate of 6% on the amount due to them, and second one being the share of profit earned for the amount due to the partner. Okay? Profit earned for the amount due to the partner, unsettled amount. And condition, the surveying partners should continue to carry on the business. The partner should not close the business. In these cases, the section 37 will be applicable. Let's see. Date of retirement. It will be applicable for death also as well as retirement also. No need to worry about that. 1/4/2023. Financial year ends on 31st March 2024. Date of retirement in this case being 30/9/2023. For this period, the deceased partner will get what? Deceased partner share. This amount will be calculated and given to the deceased partner. How? Deceased partners P&L suspense account debit to deceased partners capital. Deceased partners capital account. Clear? P&L suspense account debit to deceased partners capital. Now what about this part, sir? Unsettled capital of C being 52,000. What about the unsettled capital on this date? Balance of capital of the three partners A, B, C. C's unsettled capital being 52,000. Net profit earned by the firm after C's retirement. After C's retirement means from this date to this date. Net profit earned being 25,000. Capitals of A and B as on the date of retirement or death being 57,000 and 76,000. How do we calculate this value? Capital, accumulated reserves and surplus, revaluation profits and losses, and goodwill. All these things are added for all the partners. Okay. Who is the deceased partner here? C being the deceased partner. Thereafter A and B continuing. In this case, deceased partner's share of profit up to the date of death is calculated. This one, it is going to be also added here. The profit eligible for the period of his survival with this business for the 6 months only for C is added. After that, whatever the value you get, you know, this is what about this value, 57,000, 76,000, 52,000. And the amount payable to C's estate, 52,000 if you are delaying that money. Okay, if you are delaying to pay this. Automatically, some extra compensation should be payable by the firm to the partner. If the deed is silent, then automatically go and refer section 37. As per section 37, whichever is higher of these two will be given. Number one, whichever is higher of these two. 6% interest on the due and settled due. 52,000 into 6%. How many months are there from here to here? 6 months. Am I right? For the delay period being 6 months interest will be calculated. Come on, tell me the value. I think this is 1,560. Second one being the profit earned profit earned using his unsettled due. After the retirement, the profit earned in this case being 25,000. This 25,000 is earned by what? By these investments. What is the total investment? 57 plus 76 plus 52. 1,85,000. This 25,000 is earned using 1,85,000 rupees of fund, out of which the retiring partner, a deceased partner C, whose capital being 52,000. You earn 25,000 rupees because of 1,85,000 rupees means for 52,000 how much it should be. Otherwise, simply understand this is capital ratio. 25,000 into 52 divided by 185. Or it will be assumed to be a capital ratio. What is the final value? 70/27. Maximum of these two may be offered to the deceased partner estate. So with that 52,000, you have to pay another 7,027 additionally for the delay payment. In case of death, only these 2 points. Up to the date of death, you have to calculate a profit share and offer him only. For that, the journal entry is P&L suspense to deceased partner's capital account. Second being, if the money is delayed to pay, automatically is eligible for additional benefit. The additional benefit will be followed as per the deed if there is. If the deed is missing, then you can go for section 37. As per section 37, you can go for whichever is higher of these two may be offered to him. Clear? Come on, make a note of it. This question number 2 is a comprehensive one. A, B and C were partners of a firm sharing profits and losses in the ratio of 3:4:3. The firm had taken joint life policy 1 lakh. Premium periodically paid was charged to the profit and loss account. Partner C died on 30th September 2023. It was agreed between the surviving partners and the legal representative of C that goodwill of the firm will be taken at rupees 60. Okay. And fixed assets will be written down by 20 in lieu of profit. C should be paid at the rate of 25% per annum on his capital on 31/3/2023. Okay. Policy money was received and then the legal hires were paid off. The policy amount 1 lakh received and it is settled. That 1 lakh is paid off. The profits for the year 31st March 2023 after charging depreciation being 10,000 and depreciation up to 30th September was agreed to be 6,000 where 48,000. Clear? This is the previous year's profit. Previous year's profit. Okay, I make a correction. This will be 2024. Current year profit. Current year profit. Partners' drawings accounts show the balances. These are the drawings. On the basis of above figures, please indicate the entitlement of the legal heirs of C, assuming that they had not been paid anything other than the share in the joint life policy. Deceased partner's estate gets only the share of the joint life policy, nothing they get. Okay. Now, you have to find out what? You have to find out the capital of these 3 partners as on the date of death. As on the date of death or retirement. Is that okay? See here. 3 partners are there, A, B and C. See, preparation of capital account is not necessary. But what do you do in capital account? You have to present that as a statement. All the items shown in the credit side added. The items shown in the debit side is subtracted. That's how you can show here. What are the capitals we have here? Initial balance of ABC, 48,000. Come on, join with me and write. Come on, 48,000, 64,000, 48,000. Right. And what about the reserve? Come on, tell me. What about the reserve? Accumulated profits should be shared to the partners. in their P&L ratio? The P&L ratio being 3:4:3. Tell me. Use the calculators and tell me. Come on, make it faster. Use the calculators. This 20,000 should be shared among the three partners in the ratio of 3:4:3. How much? 6,000, 8,000, again 6,000. Right. Now, forget about the joint life policy. Why? Amount received and settled. So, you never bother about the joint life policy. Assume the amount received and immediately paid off. So, you forget about that. It has been agreed between the surviving partners and the legal representative C that goodwill of the firm will be taken at 60. In case of goodwill, what do you do? Raise the goodwill and cancel the goodwill. Usually you do. But for the calculation of the capital balance of these three partners as on the date of retirement, you raise the goodwill first of all. Only then you will know what is the real balance of these three partners, including the goodwill as on the date of death. That balance is the base for determining the share of profit offered to the partners for the delayed settlement. Okay, deceased partners for the delayed settlement. Yes, come on, tell me. This 60,000 should be shared among the three partners in their old ratio. Make it faster. 3:4:3. 18,000, 24,000, 18,000. Clear? Join with me in solving this. Join with me. Don't listen just and then copy later. No, you have to work along with me. Next one. Goodwill is over. Fixed assets will be written down by 20,000 rupees. What is this? Revaluation loss. Revaluation loss. Come on, tell me. Revaluation loss. 20,000 rupees. That 20,000 should be shared among the partners in the ratio of 3:4:3. Come on, tell me. 6,000 negative, 8,000 negative, and 6,000 negative. Revaluation loss. Revaluation loss. And then, in lieu of profit, C should be paid at the rate of 25% per annum on his capital on 31/3/2023. C, the year starts with 1/4/2022, ends on 31st March 2023. The death happened on 30th September 2023. 2023. This period, okay, in this period, what you have to do? You have to consider profit share offered to the deceased partner to C's capital. And for this period, you have to apply section 37. Is that okay? Now, how can we calculate in lieu of profits? We never bother about the profit to be calculated actually for this period. Instead of that, 25% per annum on his capital on 31/3/23 can be taken. What is the capital as on the date 31/3/23? The capital of C being 48,000. On that 48,000, you assume profit may be 25% for the whole year. But he has surveyed only for 6 months, you have to calculate for 6 months into 1/2. Come on, tell me. 6,000. This 6,000 will be now added only to whom? Only C's capital. Only C's capital. Is that okay? Step number 1. P&L suspense account. This is only for C's capital. C's capital. Clear? Then we have completed. Policy money was received and legal hires were paid off. Profits for the year ended. Profits for the year ended. Actual profit for the year ended. Okay. After charging depreciation, let's see. 1/4/2023. Okay. This is 23 and 24. I make a correction. September 20. This is the death date. 1/4/23 to 31st March 24. So 1/4/23 to 31st March 2024, the profit earned being 48,000. Profit being 48,000. after charging depreciation 10,000 rupees. See, usually profit will be what? Only after depreciation, right? This is what about the net profit. GP minus depreciation. The depreciation for the whole year, in this case being 10,000, in that up to the date of death, 30th September 2023, in this period, the depreciation being only 6,000, thereafter the depreciation being 4,000, balancing figure 4,000. Is that okay? Clear? I will explain this part separately. Meanwhile, just think why this information is given and how can we handle this. Apart from that, drawings is there. Drawings of the three partners. Drawing should be subtracted. Am I right? Drawing should be subtracted. Come on, tell me. A's drawings being 18,000, drawn evenly over the year. Now, what's my requirement? Find out the balance as on 30/9/2023 as on the date of death. I need to find out the balance of these three partners as on the date of death because we need to settle the amount due for C. If you are not settling on the date, if you are delaying, then automatically section 37 will be applicable. Capital ratio need. Because of that reason, I need to know the capital of these three partners as on the date of death 30/9/23. Drawings should be subtracted. But drawings in this case being 18,000, drawn evenly over the year, but for half year, it will be only 9,000. B's drawing 24,000, drawn evenly over the year. Half of that should be subtracted here. Evenly means every month constantly drawing. 2,000 rupees every month he draws. That's called evenly. It is not sometimes 4,000, sometimes 1,000, sometimes 5,000. It's not so. It's evenly. C's drawing is up to the date of death only. Thereafter, there is no drawings in C. Now, come on. Subtract the drawings as well as revaluation loss to find out the balance as on the date of death. Come on, tell me what's the balance? I think 57,000 for A. For B, 76,000. For C, 52,000. Clear? You can work out this as a capital account, like go and refer Singar Academy text. There I have worked out this as a capital account state. That way also you can work out, or a statement like also work out. Because here my intention is not prepare the capital account. My intention is to find out what is the amount payable to deceased partner's estate as on the date of death. If you are delaying, how much extra I have to pay? Only these two are going to be calculated. Clear? Any doubts here? Now, assuming that they have not been paid anything other than share in the joint, nothing is paid. As nothing is paid, automatically what happens hereafter? You have to find out. Now, the deceased partners paid not other than this one. Okay. Nothing is paid. Nothing is paid. For the year 23-24, the profit is 48,000 rupees. After the date of death to the date of settlement, what could be the profit? 48,000, you know. You can split that into two parts, 6 months and 6 months. Then for the first 6 months, the profit is 24,000. For the second 6 months, the profit is 24,000. It's natural. It's natural. But slight adjustment is to be incorporated here with respect to the depreciation. Evenly means the profit earned will be same in all the month. 48,000 for 12 months per month, 4,000 rupees you are earning. For the 6 months, 6 into 4, 24,000. The next half, 6 into 4, 24,000. This is called even. But depreciation being 10,000 for the year is not even for the both the half year. First half year 6,000, second half year only 4,000 rupees. If you are debiting 6,000 rupees in your P&L account rather than 4,000 rupees, the profit is lesser. Naturally, what happens the very first 6 months, the profit is lesser. For the second 6 months, the profit is higher. It is not even. It is not even. In case of drawings, no, it's even. But in case of profit, it's not even. Then how to calculate? Net profit after depreciation. After depreciation, 48,000. Add the depreciation back. The depreciation in this case being 10,000. 58,000. Net profit before depreciation. This will be splitted for the first 6 months up to 3923 up to after 3923 net profit before depreciation. How much? 58,000 will be shared between the two half years. 29,000. Is that okay? Now subtract the depreciation for the first 6 months and second 6 months from here. The first 6 months depreciation being 6,000, second 6 months depreciation being 4,000 rupees. 23,000 here being 25,000. 23 and 25. Now the profit earned after the death being 25,000. Profit after the death being 25,000. We now found out the profit earned after the death. Before the death, the profit is 23. After the death, it is 25,000 rupees. The higher profit earned in the next half year. Now, you have to add that section 37. As per that, 25,000 is the profit earned after the date of death. Should be given to deceased partner's estate as per what? Section 37. Section 37, 6% interest on the unsettled money. 52,000 into 6% for half year. What's the value? 1,560. Second one being profit earned using C's share of capital unsettled. 25,000 is the profit earned after the date of death as per the calculation we have done here. In that capital ratio being into 52 divided by 57, 76 and 52. What is the value? 1,85,000. So 185 should be the denominator value. Then final value be 1727. Between these two, higher value will be payable to him. Now final value will be payable to C being 59,027. Clear? We got this value. In the previous illustration, this capital as well as profit earned after C's retirement is given. In this class, in this illustration, we have calculated balance as on the date of death, as well as we calculated how to share the profit after the date of death under section 37. This 25,000 is calculated separately. These are the two things you have to understand. Come on, make note of it. Clear? Shall I move on to the next one? Online students, come on, respond me. Now, see, in this illustration, we are going to study how the money is settled. A partner's loan stands at 30,000 after his retirement. It has to be paid in 4 annual equal installments. That the loan is to carry 6% per annum interest. Pass journal entry and prepare ledger for the repayment of loan. Repayment of loan. What happens here? 30,000 rupees divided by 4, every installment being 7,500 plus interest also be payable on the balance. Is that okay? So loan amount being 30,000 rupees minus first installment 7,500. By the first year end, interest will be leviable at the rate of 6% on this balance. How much? 1,800. The payment should be 9,300. 9,300. 22,500. Second installment 7,500. Now what is the interest? You have only 22,500 as the balance for that 6%. 1,350. Now what is the total payment? 8,850. And the balance becomes only 15,000. Third installment, again another 7,500. Now interest being on the balance loan of 15,900. So payment being 8,400. 7,500 is again balance. And final installment, fourth installment, 7,500. Interest being 450, 7,950 is the final payment. Now, pass the journal entry. First, for the interest, you have to pass the journal entry. Interest is expenses, so interest account debit to partner's loan account. Partner's loan account. The value being 1,800. Next entry is for the payment. For the payment, partner's loan account debit to bank. How much is the payment? Installment, principal repayment along with the interest, 9,300. Third entry being, this interest is expenses, so debited to P&L account. So P&L account debit to interest on partner's loan, 1,800. That's all. The same 3 entry will be passed for the remaining 3 more years. Remaining 3 more years. For the next year, the entry 1,350, 1,350, payment being 8,850, 8,850, interest being 1,350. Clear? For the 4th year, interest being 900, 900, payment being 8,400, 8,400. And here finally, 900 is the expenses debited to the P&L account. Last entry 450 interest, payment being 7,950, 7,950. Don't write this way. You repeat all the journal entries 3-4 times in your examination. Okay. Now, how about the ledger account, sir? How about the ledger account? Partners loan account. What's the initial value by balance? 30,000, right? It's a liability for the company. If the liability increases, should be credited. If the liability decreases, debited. Very first year, interest is added on this, which is 1,800 rupees. It increases the payment to payable to partners loan, and 9,300 rupees is paid. That reduces the balance payable to them. Now, balance carried on here being 22,500. By balance next year 22,500. Add interest and add the interest with this and make the payment. You repeat this for the remaining 3 more years. That's all about the ledger account for partners loan account. Rest of the years you can finish off. We'll go for 2 additional problems and they are comprehensive also. Asa, Bibasa and Chitra are partners in a partnership firm, sharing profits and losses in the ratio of 8:7:5. From 1/4/2023, the partners decided to change their profit and loss ratio this way, 5:4:1. It is not admission or retirement, it's change of the P&L ratio. Even though if it is a change of P&L ratio, you have to follow all the procedure for the admissions. Is that okay? That's all. Rest of the things are very same like admission. Come on. 4 adjustments are there. Show single journal entry adjusting capitals for the partners on 1/4/23. To show the profit and loss account for the year ended 31st March 23 after considering the following adjustments. Okay. Now, 1/4/23, 31st March 23 balance sheet is there. So the next day onwards, they want to change this way. Furniture and machinery were to be depreciated and appreciated by 5 and 10. Provision for bad debt is to be increased to 3,000 rupees. These two are the revaluation of assets and liabilities. P&L account of the firm for the year ended 31st March 24 showed a net profit of 68,700. A contingent liability of rupees 10,000 was to be treated as actual liability. This is also revaluation liabilities. Contingent liability becomes actual liability. The partners decided not to alter the book value of the assets and liabilities and reserves, but recorded the changes by passing one single journal entry. Now, 2 aspects are there. What are they? Number 1, you have to change the P&L ratio as on 1/4/2023 onwards. So while changing, it's just similar to the admission. After the change, from 1/4/2023 to 31st March 24, they earned the profit 68,700. Now you have to prepare the P&L appropriation for that. This detail is for P&L appropriation purpose. For this second point is used. Show the P&L account for the year ended 31st March 24 after considering interest on capital and interest on B's loan and transfer 20% to the divisible profit to the reserves after charging such reserves. So, two steps are there. Number one, change in PSR. Second one being P&L appropriation account as on 31st March 24. Due to the change in PSR, you have to follow memorandum revaluation method. Why? Partners decided not to alter the book values of the assets, liabilities and reserves, but recorded the change by passing one single journal entry. So you no need to prepare a revaluation account as well as a partner's capital account here. Just to prepare a statement of these things. You can prepare as a statement. Let's see. Now compute the total profit due to the change. Okay, total profit. So reserve should be given, the value being 30,000. Furniture and machinery. Furniture depreciated, machinery appreciated. So furniture depreciated 5%. How much is that? 500 being the loss. Machinery appreciated is gain 8,000 rupees. Is that clear? Apart from that, provision for bad debt is to be increased by 3,000 rupees. PDD increase, also a loss, minus item. What is the ultimate profit and loss here? Ultimate profit and loss, come on. 30,000 plus 8,000 minus 3,500. 34,500. Okay, one more contingent liability is also there. Fourth one, the contingent liability becomes the real liability. Liability increase, which is 10,000 minus item. Then ultimate profit being 24,000. 24,500. Okay, 24,500. What will you do for the memorandum revaluation method? Raise this to the old partners in the old ratio and cancel in the new ratio. Here, old partners and new partners are the same, but ratio is different. Okay, rise. Okay, to the old partners in the old ratio. This capital. 24,500 should be shared in the ratio of 8:7:5. Come on. A will get 9,800. B will get 8,575. C will get 6,125. Cancel again to all the partners in the new ratio. The same three partners are there, but the new ratio is totally different, which is 5:4:1. And while rising, it is credited. While cancelling, it should be debited. 5:4:1. 12,250, 9,800, 2,450. The ultimate value here being 2,450 debit. For B, 1,225 debit. C, 3,675 credit. Means C is the sacrificer. Earlier 5 share, now C gets only 1 share. So he is being the sacrificer. Sacrificer will always be credited to the extent of sacrifice. So now you have to pass single journal entry to adjust this impact. Okay. A's capital account is debited 2,450. B's capital account should also be debited. This value being 1,225 to C's capital 3,675. The entire balance sheet remains the same, but the partner's capital account gets adjusted. 50,000 after 2,450 subtraction, what is the value? 47,550. Am I right? This is what about the new capital of A. B is new capital, 40 minus 1,225, 38,775. C is new capital being, you have to give a credit. So then 36,000, 33,675 will be the new value. Is that clear? So after the alteration, after the change of the P&L ratio, the new balance sheet is this way. It shows this way. Clear? So it's not only for the admission and retirement. Sometimes even change of the P&L ratio also will have the impact. Here, change of P&L ratio is there. As per the change of the P&L ratio, Asa and Vipasha and Chitra's capital are going to be adjusted this way. Because of the change in the P&L ratio, some partners may lose later, some partners may gain. The loser will be now given a credit and a gainer will be charged. Is that okay? Hope you will be now able to understand this one. Next, keeping this particular balance sheet as well as the profit earned after this changes, you have to prepare the P&L adjustment account. Okay, P&L appropriation account. If it is okay, tell me, we'll go for the P&L appropriation account. Text me, online students, come on, make it faster. Now, this is what about the adjusted balance sheet after the change in P&L ratio. The new P&L ratio being 5:4:1. Now, the net profit earned for the year being 68,700. For year 23-24 being 68,700. And what are the points that are going to be incorporated here? These are the points for the P&L appropriation. You think P&L appropriation may be easy, rare for the examination, but in this illustration, they have incorporated the change in P&L ratio as well as they have added P&L appropriation also. Now I'm going to calculate the P&L appropriation here. Come on, join with me. P&L appropriation account. By net profit, how much is that? 68,700. Now find out the interest on capital. Interest on capital to be calculated based on the adjusted one on this. Find out and post that immediately for Asha, Vibhasha and Chitra. Okay. 2378 1938. Okay. 1,684. Total being the same, 6,000, right? Interest on B's loan is payable. See, interest on B's loan, you know, that is an expenses. Okay, expenses should be debited to the P&L account, 68,700. From that, you can subtract on this 20,000 rupees. Rate of interest is not given. Then you can consider 6% will be applicable here. 6% being 1,200. Then the net profit for appropriation purpose being 67,500. Okay, it is not 68,700. 67,500. Partners' capital and the interest on that will be appropriation. Appropriation is nothing but sharing of the profit as per their contribution. Loan, actually it's not capital. Any amount payable for that is in the expenses. Expenses means charge. Interest on loan is a charge debited to the P&L account. Interest on capital is appropriation, sharing. So it should be debited to the P&L appropriation account. You have to be double cautious. Don't put here. Okay. Here the 68,700 we assume before the interest on partner's loan. So you have to find out the interest on partner's loan and subtract. Then you will be getting the net profit will be for the distribution. Transfer 20% of the divisible profit to the reserves after charging such reserve. After charging such reserve means you have to calculate 20 by 120 percentage. We have studied that commission, right? 10% is on such commission. After charging such commission, then 10 divided by 100 plus commission will take now. Similarly, you can calculate here. Transfer to GR. What is the amount you have? 67,500. This total being 6,000. So 61,500 on that. 20 by 120 is the amount transferable to the GR. This value being 10,250. Yeah, find out the balance here. 51,250 should be shared among the partners A, B, and C. In what ratio? New ratio, not the old ratio, because ratio is already changed. 5:4:1. 25,625, 20,500, and 5,125. Clear? Clear? Next question, really one of the challenging illustration and advanced also. Okay, let's see. Question number 2. Following is the balance sheet of A, B, and C, who were the partners on 31/3/24. They share profits and losses in the ratio of 2:2:1. On 1st April 24, C retired from the firm and claimed his share of secret reserves or profits. Some may be misleading. Actually, secret reserve is illegal. Secret reserve is nothing but 10,000 rupees worth of asset, stated as only 5,000 in the balance sheet. By reducing the balance assets value, you have to adjust that in the profit, stating that your profit is very lesser or loss. You intimate to the others stating that you are not making profit by hiding. This is called secret profit. Is illegal. Anyhow, they did some illegal but anyhow it should not be. But if it is so, maybe error also you can assume, rather than it may be voluntary, it may be illegal. Okay, in case of voluntary, it's illegal, right? During the year ended 31st March 24, purchase of machinery at a cost of rupees 10,000 was charged to the purchase account. The erection charges 600 being charged to the machinery repair account. It's an error, isn't it? What's the error here? Machinery purchases should be debited to the machinery account. Rather than that, they have debited to the purchases account. Similarly, the installation erection charges 600 should also be forming part of the machinery account, but they have now charged to the repairs account. These two are the wrong one. So, because of this, machinery is missed in the books. To what extent? Machinery rupees 10,000, add erection charges 600, 10,600. And eligible depreciation for this being 10%, 1060. 9,540 rupees worth machinery is not available in the P&L account, means in the asset account. They wrongly debited to the purchase account, wrongly debited to the repairs account, and because of these two debit, they forgot to debit or they are not debiting the depreciation in the P&L account. If we are doing this properly, your machinery will have 9,540 rupees in your balance sheet. In your balance sheet, you will have 9,540. Is that okay? This is error. If you are increasing the plant and machinery value by 9,540, this will be included where? In P&L adjustment account. In P&L adjustment. Is that okay? P&L suspense account. That's how we'll do. This value being 9,540. You are rectifying the error after what? After the preparation of final accounts. If you want to know the detailed journal entry, I will pass the detailed journal entry also. Okay, for the time constraint, in your examination, you have to finish up just like that. Add the assets value by 9,540, parallelly you credit that in the P&L adjustment account. For the detailed one, for this only I will explain. What is that? The correct entry being machinery account debit to machinery account debit to bank. How much is that? 10,000 plus 600, 10,600. Not only that, you have to claim the depreciation also. Depreciation account debit to machinery account. The value being 1060. This is what about the correct entry. Am I right? What is the wrong entry? Rather than machinery, they debited to the purchase account to the extent of machine's value and to the extent of erection charges charged to the repairs account to bank. They have not passed the entry for the depreciation because there is no asset. As they have not shown this as an asset, they have lost depreciation benefit also. While rectification, bank is correct. Wrong entry should be reversed, correct entry should be passed. In correct entry, machinery debit, machinery credit is there, you can club these two. Then the entry being machinery account debit, I will pass here, okay. Yeah, tell me. Machinery account debit, how much? 10,600 minus 1,060, naturally 9,540. And depreciation account debit, how much is that? 1060. And wrong entry should be reversed. Two purchases, 10,000. Two repairs, 600. This is what about the rectification entry. Remember, if you are rectifying after the preparation of final accounts in the next financial year, you need to rename all the nominal accounts to P&L adjustment account, isn't it? So, we are rectifying only in the next year's first date. So, I am renaming this. Depreciation is renamed as P&L adjustment account. Purchases nominal account renamed as P&L account. Repairs also renamed as P&L account. Now, the ultimate entry being machinery account debit 9,540 and P&L account debit 1,060. In credit we have P&L account 10,602. So you can club these two and make it single. Combine this P&L adjustment account. The value being 9,540. I got this value straight away. The rectification, what you do know, I can get the answer just like that by using the ultimate answer difference in the value of the assets. Because of this error, we missed to record the value of the assets in the balance sheet. What could be the value of the assets in the balance sheet by the year end? It should be 9,540. If I show this in the balance sheet asset side, parallelly in liability side, it will have the impact in the profit loss. This profit loss, if it is purposefully they do, then it's called secret profit. Purposefully, but it's illegal. Okay. Maybe getting arrested also. Benami and all these things are there. So it's illegal. Anyhow, it happened. The retaining partner says, so we have hidden one asset, one profit, you have to calculate and give to me. Only then I'll get retained. Okay, hope you'll be now able to understand this one. Second one, 600 received from Mr. X on 31/3/24 towards rent of the property sublet was credited to his personal account instead of to rent account, so as to reduce his debit balance from 1000 to 600. Okay, now there is one more error. Mr. X paid 600 rupees. See, Mr. X has to pay 1000 rupees. So in our book, Mr. X being debtor, debit balance. Mr. X has paid 600 rupees to us. Okay. The payment made by Mr. X is 600 rupees. Okay. ABC Limited. Okay. ABC gets 600 rupees. What ABC says? The moment he received 600 rupees from Mr. X, he simply subtracted from here, and thereafter the amount recoverable being only 400 like. What is the journal entry if you are receiving the money from Mr. X? Bank account debit to Mr. X. Already Mr. X has to pay us 1000 rupees. There is a debit balance in the balance sheet. Mr. X may be one of the debtor, 1000 rupees. The moment he paid 600 rupees, no, we subtracted this and rewritten as 400 rupees. Later on, we realized Mr. X paid this 600 rupees is no, not for this purpose. He is enjoying one more facility from us, which is nothing but sublet of our property. We have given our property also for additional use, subletting. And for the subletting, he has paid the 600 rupees. This 600 is not for this one, is for subletting. Then what is the correct entry? Bank account debit to rent from subletting, rent received from subletting. What is the wrong entry we have passed? Bank account debit to X account. In his personal account, we assumed he has paid only his existing due. No, the existing due remains the same. He has to pay the money for the subletting. No, he missed to pay that. So this is the correct entry. Now what is the rectification entry? Bank, no problem. And rent, to rent 600. And here it should be cancelled by debiting. X account debit 600. As you plan to rectify, you are rectifying only after the preparation of final accounts. Nominal account will be renamed to P&L adjustment account. P&L adjustment account. Is that clear? Because of this, what happens? X is here only. His balance increases by 600. Parallelly, P&L adjustment account also increases by 600. Is that clear? So in X, debtors balance increases by 600. Parallelly, it will be increasing the assets value also. Clear? Hope you will be now able to understand this logic. All the three are the errors like you have to rectify. Interest on mortgage loan was paid in advance up to 31/5/24, and then the whole amount was charged. Actually, there's a loan, right? Mortgage loan 16,600. For that, applicable rate of interest is 15%. We have paid the interest for this loan for how many years? Not how many years, 2 months additional to this year. We had to close the books of accounts on 31st March 24, but the payment is made on this date. So for 16,600, what is the rate of interest? 15%. How many months rent interest you paid in advance? After this date, 2 months interest is paid in advance into 2/12. What is the final value here? Come on. Make it faster. 450. What is the journal entry for this? If you pay the rent in interest in advance, usually the entry may be this way. You could have passed interest account debit to bank. Later on, you realize that interest payment is for the next period also. You have to reverse this. How can you reverse? Very simple. Interest paid in advance account debit to interest account. Okay, the value being 415. What do you do in case of payment of expenses in advance? Usually you subtract from there, right? So the rent paid may be 15,000, actual rent is only 12,000 rupees. In your P&L account, you put that value 15,000 in your column minus 3,000, only 12,000 for this period. The amount 3,000 subtracted is your asset. Expenses paid in advance will go to the balance sheet asset side. Similarly, you are rectifying this only after the final accounts preparation. So the interest is now renamed with P&L adjustment account. P&L adjustment account. Interest advance is nothing but an asset now. So interest advance. Interest paid in advance 415, that will be addable with P&L adjustment account. Is that clear? This will be the revised balance sheet. This will be the revised balance sheet. Clear? So C retired from the firm claimed his share of secret reserve of profit. What is the secret profit? You add up the three. This is what about the total profit hidden or because of the error missed. Now he demands a share in that also. We have to finish off. What is the total value? Come on, all the three. I think this value being 10,555. 10,555. He demands this. After rectifying the above, it was mutually decided as under. After rectification only, C demands, okay, thereafter I may ready to retain. Now finish off adjusting this part first of all. This part first of all, okay. One of the interesting illustrations. Now, you have to prepare what? P&L adjustment account for rectifying this error. Plant and machinery. By plant and machinery account debit to P&L adjustment account 9,540. And debtors 600. Interest paid in advance 415. Now the overall value being 10,555 should be shared to the partners A, B, C. In what ratio? Okay, 2:1 ratio. So 4,222, 4,222, 2,111. Now the new balance sheet. Of course, this balance sheet not required, but to make you understand, I may prepare this balance sheet also. Plant and machinery 58,540. Okay. Furniture and fittings 4,800. Stock in trade 22,800. This balance sheet not required. Anyhow, for the understanding, I am writing this one. So 22,200. Cash 1,000, bank 200, interest paid in advance 415. Here capital A, B, C. Come on, tell me. 33,600 after adding the adjustment of secret profit 4,222. What is the new value? What's the new value? 37,822. And this one 25,200 should be inflated with this profit 29,422. And for C 12,000 with that 2,111 will be addable 14,111. Okay, then sundry creditors remains the same. And mortgage loan 15% loan 16,600. Get me the total of balance sheet. Of course, this is not required. This is not required. But anyhow, you will be now able to understand the errors rectified and prepare the balance sheet after the rectification. after the rectification. In the text, I just directly clubbed with the retirement also. What is the total of balance sheet? 1 lakh? 1 lakh? I doubt. 1 lakh? 1 second, 1 second. Yeah, 1 lakh 9,955. Yeah, correct. Okay. Of course, this balance sheet not required. This balance sheet not required. Let's see. Hereafter, after rectifying the above, it was mutually decided as under. Goodwill of the firm is valued at 5 times the average profit of the last 3 years. Such profit should be the correct profits, not the book profits. So 5 times 5 years purchase of 3 years average profit. 21, 22, 22, 23, 23, 24. Profit being 18, 380, 32,000, 7,471. Such profit should be the correct profit. In the year 23-24, there is an error. Due to that, 10,555 rupees decreased. Isn't it? Because of the error, the profit in the last year is lesser. If I add the 10,555, that's what about the adjusted profit. So the correct profit being, come on, 18,380, 32,000 here. 18,026. Okay. Now get me the total here. 406. Divide this by 3 and 5 times purchase. Then what is the goodwill here? 1,14,010. Okay. Now C retained, right? Now what is the new ratio? New ratio detail is not given, I think. C should be paid half of his dues in cash, which shall be brought in by A and B in their profit sharing proportion, and the other half shall be left in the business. Profit sharing proportion. As nothing stated, the old ratio being 2:2:1. After C's retirement, it will be 2:2, otherwise 1:1. 1:1. Now, how can you adjust the goodwill here? How will you adjust the goodwill? Raise the goodwill and cancel the goodwill. Yes. Raise the goodwill and cancel the goodwill. Who are they? A, B, C. Raise the goodwill to all partners in the old ratio. Our old partners, the old ratio. Come on. 2:2:1. 45,604. 45,604. Finally. 22,802. Now cancel this to the continuing partner in the new ratio. New ratio. We don't have C hereafter. The entire 1,14,10 should be shared between these two. How much? 57,005. 57,005. 11,401. 11,401. 22,802. Credit for these two, debit. Clear? Now I am going to prepare what? All the things for retirement. Yes, join with me. Prepare revaluation account, capital account, and then balance sheet. Now, revaluation account, balance sheet, capital account, A, B, C. Old ratio being 2:2:1, new ratio being 1:1. Adjustment A is okay. Plant and machinery to be depreciated. So what do you do while preparing the new to retire? Make this to partner retire. What do you have to do? Prepare the revaluation account, capital account, and balance sheet. Before you incorporate adjustments, try to finish off posting the items given here. Plant and machinery, the value being 58,540. Furniture fixtures 4,800. Stock 22,800. Debtors 22,200. Cash 1,000. Bank 200. Interest advance 415. Capital of partners 37,822, 29,422, 14,111. Creditors 12,000, 15% loan 16,600. We have posted all the balance sheet items. Now incorporate the goodwill thing. 11,401 charge to A as well as B will be credited in C's capital account 22,802. Here A and B, here C capital. Clear? Now we'll go for the B. Plant and machinery to be depreciated by 10%. So you have to subtract 10%. Okay. Plant and machinery value decreases by 10%, 5,840. After 10%, what is the final value? Calculate. 52,686. 52,686. Okay. And provision for doubtful debts being 5%. Here 5%. So provision for doubtful debts. 1,110. If I subtract 1,110, what is the new value? 21,090. Goodwill should not appear in the books. Already we treated that same way. There is a liability of rupees 501 for bills discounted. This was to be accounted for. A new liability arises. Bill liability 501. So new liability increases 501. C should be paid half of his dues in cash, which shall be brought in by A and B in their profit sharing proportion, equal ratio. Right. So let's finish off a revaluation account. Okay, 854. Now the total here being 7465. 7465 should be shared among the partners A, B, C in their P&L ratio being 2:2:1. 2986, 2986. 1493. I can transfer here. Revaluation loss 2986, 2986, 1493. Now tally the C's capital first of all. Out of that, 50% is immediately paid. 33,913. 33,913. Then what is the value you are getting? I think the balance value being 35,420. 34,420. This is 36, right? This is 36,000. 36,000. Final value being 35,410. Out of that, 50%, 710 will be payable by A and B equally, means as per their P&L ratio. C brings in cash taken by C. A and B brings in cash and taken by C. The amount payable to C after retirement being 35,410. 410 or 420? 420. 50%, 710 is paid by A and B. Shared by A and B equally. Come on, share this equally. A will bring 8,855. B will bring 8,855. Balance 17,710 will be payable after 1 year along with the interest at the rate of 18%. So here C is loan. C is loan. So C is loan. 17,710. And now finish off tallying A and B's capital account also. 46,677, 38,277. 46,677 and 38,277. Here balance of these two partners being 32,290, 23,890. So capital for A and B 32,290, 23,890. 890. Yeah, there is no any change for furniture fixtures, stock, cash, bank and advance. All these things being the same values. Then if you tally, final value being 1,02,991. Okay, 1,02,991. This is one of the interesting and advanced illustrations. So with that, we have completed reconstitution of firms completely. So after the break, we'll start with the dissolution case. Okay. Dissolution of partnership. So firm can be dissolved. Okay, voluntarily or some action, but all the assets sold in single lot and amount recovered is used for settling various liabilities in single shot. Another one is we sell the asset one by one. The amount what we receive by selling the asset can be used for settling the liabilities one by one as per the priority rule. That is the piecemeal distribution. Under piecemeal distribution, we have capital proportionate method as well as maximum loss method. So we'll study this in the next class. In this class, our focus is to close the business in single lot. We'll start with some basic illustration. Second being, if one partner is insolvent, then the amount recoverable from the insolvent partner to be handled as per the deed or Garner versus Murray rule. The third one is what happens if all partners are insolvent. All partners are insolvent. One partner insolvent, all partners insolvent case. So dissolution by single lot, dissolution basic, dissolution with a partner insolvent, where we may use either deeds as per the deed or we can solve the problem as per the Garner versus Murray rule. And dissolution, where all partners are insolvent, we need to prepare deficiency. These are the three models, very simple. And of course, similar to what you have studied, retirement and dissolution, means retirement and death, the same way you have to open all the ledgers. But step number 1, open the ledger. What are the ledgers are going to be opened here? Realization account, you are not going to open the revaluation here, because we are selling all the assets, means assets realized in cash. As asset realized in cash, we are going to prepare the realization account, not the account we prepared earlier. Revaluation is not applicable here. And then capital account. As the company is closed completely, we don't have what? Hereafter, assets and liabilities we don't have. Then all the assets sold, money recovered can be used for settling the liabilities. Will be done in a new account called bank or cash account. That's all. These are the three predominant ledgers you have to open. Step number 1. Step number 2, record the balance sheet items similar to the way how we used for admission as well as retirement. But here, assets are there shown in the asset side of the balance sheet, liabilities are shown in the liability side of the balance sheet. Here it's not so. All the assets are transferred here. All the assets are shown here at book value. All liabilities are shown here at book value. At book value. Is that clear? Owner's fund, as usual, by balance to the partners, and accumulated reserves and surplus or profits and losses should be shared to the whole partners in the whole ratio. So, record the balance sheet items once. Assets should be in the debit side of the realization account at what value? Book value. Liabilities should be shown in the credit side of the realization account at book value. Capital will go to the capital account, and in case of accumulated profits and losses will be shared to the partners, will be transferred to the partners as per their P&L ratio, old ratio to all partners. Then you have to now read the adjustments and incorporate that. While recording the adjustment item, it should be posted twice. What are the things are there? Okay, what are the things are there? So you have assets and liabilities. Assets may be sold and cash realized. Asset may be sold and cash realized. Using that cash, we can settle the liabilities, part 1. Sometimes the asset may be taken by the partner. Don't sell to the outsider. You get very lesser amount. I need this, so I'll take up. You can adjust this value in my capital account. Sometimes some of the partners will take care of the settlement of liabilities. This lender, I personally know him. I'll convince him and I'll pay him. You give the money to me. So he takes the responsibility of settling the liabilities also. Sometimes, one of the lender demands to settle this, automatically I handed over the assets to him. Is that clear? So these are the three chances are there. One is sell the assets and realize the cash. Using the cash, pay the liabilities. Another one is some assets may be taken by the partners, as it is not advisable to sell in the market. It may realize very lesser amount. And some partners will take the responsibility of settling the liabilities also. Sometimes the asset is handed over to the liabilities. Right. And this process we do know has the expenses, selling the assets and settling the liabilities. We may depend on some third party. We pay some commission and expenses and all. That is called realization expenses. So you have to understand, to incorporate, these are the 4 aspects: selling assets and settling liabilities, asset taken over by the partner, or sometimes maybe liabilities settled by the partners, assets and liabilities mutually cancel, and realization expenses. These 4 are being given in the adjustments, should be posted twice so that it will be comfortably settled. Sale of assets taken by the partner, given for the debt. If assets sold, here put the bank in brackets, assets sold. Automatically go to the bank account. Of course, opening balance will be here. Apart from that, realization account, amount recovered by selling the asset. Here, bank, for what? Liabilities taken over. Here, by realization, liabilities taken over. Liabilities sold off. Not only sale, sometimes what? The assets may be taken by the partner. Liability settlement is responsible by a partner, taken responsibility by a partner. In that case, asset taken means automatically here capital account for asset taken over. This will reduce the amount payable to the partners to realization asset taken over. Is that okay? Realization asset taken over. Asset taken over. Probably A takes over. Only A takes over. Or B takes over. Or it may be. Sometimes liability may be settled by one of the partners, then capital account. Suppose the liability is taken by B. Here, realization account for the liabilities taken by the B. If the liabilities is settled by the partners, amount payable to the partners is increasing. If the asset taken by the partners, amount payable to the partner after settling that asset, balance is payable. Balance is payable. Similarly, sometimes the assets and liabilities mutually cancel. Usually, you don't pass any entry. It has no logic. You don't need to worry about that. Or you can parallelly write here asset, here liabilities. That's how you can cancel this one also. Mutually cancel. Mutually cancel. Okay, asset and liabilities mutually cancel. That's how you can pass the entry. Hope you'll be now able to understand this set. Sale of assets taken by the partner given for debt. Settlement of liabilities taken by the partner and settled by way of assets. Apart from that, you need to spend money for realizing this assets and this. It's an expenses, like usually in P&L account you debit the expenses, right? So here realization is also an expenses, can be debited directly to the P&L account, like here realization account, here bank realization expenses. Realization expenses. Naturally here realization for expenses. Payment is done. So 4 steps. Step 1, open the ledgers. What are the ledgers supposed to be open? You have to open realization account, capital account. We don't have the balance sheet, we have the bank account, because we are completely closing the business. Record the balance sheet items. Those things are recorded only once. Assets will be shown in the debit side of the realization account, liabilities in the credit side of the realization account, capital will go to the partner's capital account, and accumulated profits and losses should be distributed. And adjustment entries should be posted twice. The asset may be sold, liabilities may be settled. Asset may be taken by the partner and liabilities may be settled by one of the partners. Assets and liabilities are mutually settled. Is that okay? And finally, realization expenses. After that, close the books of accounts. If you close, then you will get either profit or loss similar to the revaluation profit. Here also you have realization profit transferred to the partner's capital account in their old ratio. And tally this, whatever the balance you left over, no, it's not closing balance. That will be paid off bank. Payment is done. Payment is done. Transfer here. Finally, if you tally the bank account, it gets closed. That's all. The entire company is closed. We'll start with some basic illustrations so that you'll be able to understand. Then we'll go for the insolvency. Most of the cases, in case of dissolution, you can expect the illustration with one insolvency partner. Okay, one insolvency. Gardner versus Murray will be most important. Let's now start with the illustration here. Yeah, question number 1. Right. Basic problem. Yes. Come on, open the ledgers with me. So what are the ledgers to be open? realization account. It is not revaluation. Remember, it's also a nominal account like profit or loss account. And bank account, bank and cash, and capital account, capital account. XYZ are partners sharing profits and losses in the ratio of 3:2:1. So we open the ledger. Now record the balance sheet items once. How to record? All the assets will go to realization account except cash. Cash, we have the cash account, so I post that here. Balance brought down. The value being 10,000. All the other asset is now will be debited to the realization account. Okay. Fixed asset, the value being 5 lakhs. Stock in trade, the value being 3 lakhs. Debtors, the value being 5 lakhs. And partners capital account. So we have 3 partners, X, Y, Z. And their P&L ratio being 4:3:2. Balance 4 lakhs, 3 lakhs, and 2 lakhs. GR, yes. What do you have to do? GR should be transferred to the partners. 90 should be shared among the 3 partners. 4:3:2. 40,000, 30,000, 20,000. Sundry creditors 3 lakhs 20. 3 lakhs 20. Hope now you'll be able to understand. So balance sheet items posted. Now you have to incorporate the adjustment items twice. Right. These are the adjustments. Partners of the firm decided to dissolve the firm on the above said date. It was found that a credit purchase 20,000 in January 24 had not been recorded in the books of the firm. Okay. So we have missed to record the credit purchases. Automatically what happens, the amount payable to the creditors being 3 lakhs 20. But another 20,000 rupees is missed. Purchases to creditors. The amount actually payable to the creditors being 3 lakhs 40,000 rupees. We no need to worry about the adjustments in the profit or loss account. Never bother about that. Fixed assets realized 5 lakhs 20,000 rupees. So bank. Fixed assets sold and amount realized being 5 lakhs 20,000 rupees. You are selling all the assets. Book debt rupees 4 lakhs 40,000 rupees debtors. 5 lakhs we realized only 4 lakhs 40,000 rupees. All the assets are sold. You just put the tick mark for that. If the assets sold or taken over or settled for any liability. And stock was valued 2.5 lakhs and it was taken over by partner Y. Y's capital. For what? He has taken the stock. Stock is taken at what rate? 2.5 lakhs. Though the book value is 3 lakhs, taken only 2 lakhs 50. Creditors allowed to discount 5%. So 3 lakhs 40,000 rupees, you know, actually amount payable to the creditors. 5% discount they offer. 17,000 rupees. Ultimate value being 3 lakhs 23,000 is payable. So here bank for creditors. 3 lakhs 23,000 is payable. And there's a realization expenses rupees 6,000. Realization expenses payable 6,000. Currently I have posted only once, but adjustment should be posted 2 times. Clear? The next entry being All the values shown here will go in the bank account, realization account. Under that, payment to the creditors 3,23,000, and for realization expenses, the payment being only 6,000. And fixed assets sold and we collected 5,20,000. Debtors we collected 4,40,000 rupees. Stock taken by Y, so I will post that value in Y's capital account. The amount payable to Y being 3 lakhs plus 3330. For that, he has taken one stock. Balance will be settled later on. So 2 lakhs 50. Realization account for stock. Hope now you'll be able to understand this one very easily. Record the balance sheet items and record the adjustments twice. Now, step red color is a step 1, blue color is a step 2, green color is a step 4, 3, and step 4 will go for the maroon color, right? Yeah, come on. Tally this and find out if there is any profit or loss. Come on. Use the calculators. I hope you will be facing loss. 16 lakhs 29,000. 16 lakhs 29,000. Loss being 99,000. Am I right? Yeah. Tell me. And it should be transferable to X to Y, Z in their P&L ratio being 4:3:2. For X it is 44,000. For Y it is 33,000. For Z 22,000. There is a realization loss. So I charge the partner's capital account 44,000 for X, 33,000 for Y, and 22,000 for Z. Now, finish up tallying the capital account. For X, 4 lakhs 40, 4 lakhs 40, 3 lakhs 96,000 is the balancing figure. Am I right? That should be anyhow paid by way of cash, bank. Here, capital account. Amount payable to X being 3 lakhs 96,000. In case of Y, 3 lakhs 30, 3 lakhs 30. Subtract these two values, the final value being 47,000. Here Y 47,000. 2 lakhs 20,000. 2 lakhs 20,000. Balance being 1 lakh 98,000. 1 lakh 98,000. At the last, if you tally the bank account, it gets closed automatically. Yes, there may be some error. 9 lakh 70,000 rupees. 9 lakh 70,000. Is that clear? So we started with one basic illustration. You'll be now able to understand this easily. Clear? Come on, make it faster. Next question in the same pattern but bit advanced. Okay, come try it yourself, make it faster. Open the realization account, bank account, and capital account, and post the balance sheet items, and then you start incorporate all the adjustment items to the extent known. Okay, make it faster, make it faster. Question number 2, Asha, Rekha, and Ashok. You need to try it yourself, and then if you have doubt, you can listen my lecture. Yes, you can try it yourself. Make it faster. Make it faster. Asha, Rekha, Ashok are the partners sharing profits and losses in the ratio of 5:3:2. On March 31st, 2024, they decided to dissolve the partnership firm. And the balance sheet given and other things also there. Prepare realization account, bank account, partners capital account to close the books of accounts. Right. Realization account, capital account, and cash account. First, to finish off posting the balance sheet items. The P&L ratio being 5:3:2. Partners are Asha, Rekha, and Ashok. Asha, Rekha, Ashok. Asha, Rekha, Ashok. Okay. Balance sheet items. Capital, balance. Balance brought down. I start posting the liability side items first of all. Ashok and Asha's capital being 96,000, 84,000. General reserve should be shared among the partners. 24,000. The ratio being 5:3:2. So 12,000, 4,800, 7,200, I think. And creditors. Realization account credit side 72,000. Bills payable 24,000. Ashok loan, Mrs. Ashok loan 12,000 rupees, also loan. Investment fluctuation fund, specific reserve 6,000. Asset side, debtors, always write the original value here 5,400. PDD should be posted the other side. Don't net it. And capital, Rekha's capital is in negative overdraft. Okay. Rekha's capital 12,000 rupees should be in the debit side. Land and building 96,000. Stock 54,000. Furniture 36,000, BR 30,000, investment 30,000 rupees. Cash 12,000 rupees should be in the cash book. Okay, balance. Okay. Clear? How many of you completed this? Nothing is there. Okay, you can finish up faster. 1, 2. How many of you completed? Right. Good. Finish up this. Thereafter, adjustment one after one. So around 20% load is over. We never bother about this hereafter. So now it seems to be only 6 adjustments, 6 one-word questions like. Let me first finish off first 3 items. First 3 items. Yes. 22,800 were paid to creditor against only 15,600 provided for in the books of accounts. Payment, bank. Creditors. 22,800 were paid to creditors as against only 15,600 provided for in the books. Okay. So how much payment is made? Okay. What is the total creditors? 72,000. Out of that, for 15,600, no, the payment is 22,200 to 22,800. I'm not aware about what about the remaining creditors. There was a bad debt of rupees 8,400 and discount of 10% was allowed to debtors. Bank for debtors. 5,400 where 8,400 being the bad debt, balance 42,000, 10% discount is also allowed, the ultimate value being 37,800. Am I right? 37,800. The payment to debtors 5,400 originally, 8,400 bad debt. So for balance, 10% discount demanded. So we offered them. So we collected only 37,800. Once the debtors is closed, the PDD should also be ticked. Whenever there is a specific reserve, once the asset is closed, that specific reserve should also be closed. 5,400 is the original value. Don't write the net value. Always remember, you have to write the original value. Whenever the discount bad debt comes from the original value only, you have to calculate, not the discounted value. PDD should not be subtracted. So from 5,400, 8,400 bad debt is subtracted, balance 42,000 recoverable. In that, they demanded 10% discounts. We offered them also. That 4,200 also subtracted, so 37,800 is the final amount you recovered from them. Bills payable were due on an average 3 months, were paid immediately at a discount of 12 months, 12%. So bills payable. Okay, we had to pay the bills payable 3 months after, but we plan to settle immediately. What's the amount? 24,000. 3 months time is there. As we pay ahead, we can subtract the discount also. We can demand discount 12% per annum, but for 3 months 3% will be subtracted. How much is that? Come on, 3%. 720, then 23,280 is the final payment you are going to do. 23,280. Creditors will keep it pending because out of 72,000, only 15,600 information is given. Rest we have to calculate, so I will keep it pending. So adjustment number 2, adjustment number 1. This may be adjustment number 3. Next, 4 and 5. Let me take 4 and 5 here. Investment realized 26,400. Investment. Okay. 26,400. Once investment is closed, investment fluctuation fund related to that also be closed. And land and building was sold for 1,20,000. Land and building. Put the tick mark. 96,000 worth land and building sold for 1,20,000. Stock released 20% lesser. Stock 54 minus 20% lesser. How much is that? 43,200 only you recovered. Ashok agreed to pay Mrs. loan. So Ashok, this Mrs. loan is taken by Ashok, A's capital. Ashok capital. Mrs. loan. The value being 12,000 rupees. He takes the responsibility. So for Ashok, now we have to pay 12,000 extra. Already 4,800 as per the capital. Because he settles one liability, the firm has to pay for that also. So Mrs. realization account, Mrs. loan. Mrs. loan. Okay. $12,000. And took over furniture. Ashok took over furniture also. Should be in Ashok capital. In brackets furniture. Furniture taken at 33,600. 33,600. Here. Realization. For furniture. Who takes this? Ashok. The rate being 33,600. So adjustment 4 and 5 over. Adjustment 4 and 5 over. Adjustment 6. A rebate of 1,200 was given to bill receivable. So bills receivable. Bank. Under that BR. Rebate 1,200 is given. 28,800 may be collected. And expenses and dissolution 3,600 which were paid by Reka. So Reka's capital. Reka's capital. She pays the realization expenses. How much? 3,600. Now firm has to pay this to Reka. So Reka's capital increases due to this. Okay, this will be realization expenses, realization account. I think this 84,000 is Ashok, right? Yeah, this 84,000 is Ashok, not here. Now, cross verify whether all these things are got ticked. All the assets got ticked. So no need to worry about that. In liabilities, this 72,000 remains pending. We have separate working note for this. Creditors. Creditors 72,000. In that for 15,600, final payment is 22,800. What is the balance amount? Yeah, tell me. What is the balance amount? Use the calculator. 72,000, 15,600 paid off. Balance 50, 56 to 200, 400. If nothing stated, we assume this will be settled as it is in the book's value. Now, what is the final value? 79,200 will be the final settlement. 79,200. So I told you to put the tick mark for every item you have entered. Finally, you have to cross verify if there is any unticked item. It means those things will be closed at the book value. Asset means sold at the book value. Liabilities means at the book value it is closed. Here, creditors to this extent value remains uninformed in the adjustment. So then you assume it is settled at the same value. You can assume it is settled at the same value. Hope all these things are over. Now finally you just go for closing the books account one after one. On telling the realization account, I think you'll get the loss. Debit side value is higher, 4,14,480, 4,14,480, 8,280, 8,280. Should be transferable to the partner's capital account, Asha, Rekha, and Ashok. In their P&L ratio 5:3:2. Yeah, 4,140, 2,484, 1,656. Now you can transfer here. Realization loss 4,140, 2,484, and 1,656. Cross verify for the double entry. These two not entered twice. So here realization account. For creditors bills payable, the payment being 79,200, 23,280. This 12 and 3,600 were already recorded. And collection from all these things, BR, realization account, collection being for the BR 28,800, debtors 37,800, investments 26,400, land and building 1,20,000, stock 43,200. Furniture was taken by one of the partners. Finally, close the capital account to find out whether firm has to pay or firm has to recover. In case of Ashok, 1,08,000, 1,08,000, 1,03,860 bank or cash. I'll post here. Capital account, payment to capital account, Asha, 1,03,860. In case of Rekha, the number is reverse. 14,484 and here 2,484 balance in the bank. Rekha's capital, 2,484. In case of Ashok, 1,08,000, bank balance being 65,544. So here Ashok 65,544. Finally, tally the cash account, 2,71,884. 2,71,884. It gets agreed. Hope you'll be now able to understand. Clear? Make it faster. $3,684. Okay. 3,684. Okay, stand correct. Now, we'll move on to the next illustration. Clear? If it is clear, text me. So, we'll move on to the next illustration. Now, if single partner is insolvent, bills payable 3% discount, yearly 12%. Bill gets matured in 3 months, means you have to calculate for 3 months. So, into 3 by 12. 3% subtracted. Is that clear? Now, in case if one partner is insolvent, how can we work out? Actually, Garner, Murray, Wilkins were the partners. So, one of the oldest case law. Usually, what happens now? Whatever the things we do is as per the deed only. If the deed is absent, then we'll go and refer what? Act, Partnership Act. Even though if the act is missing, what we can do? The problem is resorted through court law. In court, the case may be discussed and judgment may be given. The judgment given will also be a method to claim or to calculate some of the provisions, for calculating some of the sharing and other things also, right? We have seen in case of P&L ratio, if the P&L ratio is missing, then equally shared. In case deed is silent, you can go and refer the act shared equally, and section 37 also we referred. If the act is also missing, then you have to go and refer court only, court's proceedings. Here there is a case between Gardner and Murray, and judgment is given by Justice Joyce by the time. Actually, in their partnership firm, 3 partners were there. Among them, one partner is insolvent. One partner, Wilkins is insolvent. As that partner is insolvent, never bother about, we don't have the options to collect the amount recoverable from Wilkins. Is that okay? On telling the realization account, they faced loss in realization also. 3 situations. Situation 1, 3 partners, and one partner is insolvent, and on telling the realization, there is a loss. There is a loss. Is that okay? Then this situation went to the court. Because of this reason, realization account, capital account, Gardner, Murray, Wilkins. Gardner, Murray, Wilkins. Here there is a realization loss. Transferable to Gardner, Murray, Wilkins. 1,000, 500, 500. Debited here, realization loss. No doubt in this. On telling that Wilkins has no capital at all, after debiting this 500 rupees, 500 rupees remains negative for Wilkins. If the balance is negative in capital account, he has to bring in, right? But here, Wilkins is insolvent. Realization showed loss, the loss is shared to the capital account. After sharing, while closing the capital account, Wilkins' balance is negative. The illustration what we have referred here in case, I think Rekha or Rekha's case. In Rekha's case, the value is negative. Then we asked her to bring this money. She brought and we invested. Is that okay? But what happens if Rekha being insolvent? she has no cash at all. Okay, she has no cash at all. She could not bring this cash. That was the situation. As Wilkins is insolvent, this is the problem. Who has to care about this loss? In case of partnership firm, any loss due to business operation will be shared by the partners, isn't it? Or as per their agreed ratio, or equally as per the partnership act. But here, this 500 rupees loss due to Wilkins in insolvency, not due to the business loss. Now the trouble comes: who has to share this loss, whether G or M, Garner or Murray? Then it went to the court, and Garner Murray argued, I will not share. Murray said, I will not agree. Wilkins is already insolvent, he has no money, so we cannot do anything with him. Now we have to answer for this. So, no deed to share the loss of deficiency due to the insolvency part. You have to first follow the deed if available. No, sir. Or you can go and refer the act. Is it available to adjust this loss? No, sir. Then finally, this situation went to the court. In that court, especially Garner versus Murray judgment, then it is given. Once it is given, it is going to be followed hereafter in similar situation. What is given here? This loss, will be shared by the solvent partners in their capital ratio. It's a special loss. The partner who invested more is capable of adjusting more loss. That's how the judge thought. Judge thought and asked to the solvent partners to adjust this loss using the capital ratio. Provided the first day, the judgment is not this one. Actually, during the argument, they represented two losses. One is realization loss. Next one is loss due to the insolvency partner. This is realization loss. This is insolvent partner's loss. Judge got somehow okay. Now, two losses are there. One loss is all about realization loss. After adjusting the realization loss, one of the partners' balance is negative. He has to bring in, but he is insolvent. He could not bring this. This loss will be adjusted as per the deed, but deed is silent. Else he can go and refer the act. Act is silent. Then this case is went to the court, and court now decides. What the court decides? Actually, two losses represented to the court. One is realization loss, another one is this one. Then the judge gave the first judgment, which is actually irrelevant. Actually irrelevant. What is that? This loss is adjusted. After adjusting, whatever the leftover will be payable to the G and the M. No. But judges say, solvent partners should bring cash for realization loss. Surprised. Garner, Murray, both are, who are they? Solvent partners? No. Their realization loss, should be brought in by these two partners by way of cash. That's how the judgment is given. Actual issue is what? How to adjust the loss of Wilkins. But the judge gave the first judgment related to the realization loss. If the realization loss is there, insolvent partner could not bring. Okay, leave him. Solvent partners, you too should bring and deposit. That's how the judgment is given. That's how the judgment is given. The next day only, this is another crux. Okay, I now give the judgment for this. The insolvent partners' loss will be solved by the solvent partners using their capital ratio. 2 points are going to be incorporated here. Solvent partners should bring cash for realization loss, number one, which is actually irrelevant. Anyhow, we still follow. Second one being, solvent partners should share the deficiency in their capital ratio. Insolvent partners' loss should be shared by other partners using their capital ratio. Two things. The main point to be noted is only these two. Realization loss should be brought in the form of cash by the solvent partners. Insolvent partners' deficiency will be shared by the solvent partners using their capital ratio. Only these two. Right. Let me solve this illustration. Listen. Yeah, of course, you can start prepare yourself. Open the ledger and post all these balance sheet items and record the adjustment items also twice. Up to that, there is no problem. Only at the time of closure, the problem arises. Come on, finish up doing this yourself. 4 partners are there: Neptune, Jupiter, Venus. 4 partners are there. Now, so realization account, cash or bank account, capital account. Neptune, Jupiter, Venus, Pluto had been carrying on business in partnership, sharing profits and losses in the ratio of 3:2:1. 1:1. Neptune, Jupiter, Venus, and Pluto. Let me finish posting the balance sheet items first of all. Assets and liabilities. Yes. For the partners, Neptune, Jupiter, Venus, and Pluto. Neptune, Jupiter, Venus, and Pluto. Their P&L ratio being 3:2:1:1. Premises, asset 1,20,000. Furniture 40. Stock 1 lakh. Debtors 40. Cash in bank account, I put this as a balance 8,000. Capital overdrawn balance, debit side balance. Venus and Pluto withdrawn amount higher than the amount available. And capital of these 2 partners already available, Neptune and Pluto, 1 lakh for Neptune. Jupiter 60, Jupiter 60. Nothing for Venus and Pluto. GR and capital reserve 70 can be shared to these 2, 3, 4, 70. I club and share this 30,000 rupees, 20,000 rupees, 10,000 rupees, 10,000 rupees. And sundry creditors, 20,000 rupees. Mortgage loan, 80,000 rupees. Mortgage loan, 80,000 rupees. So I just completed balance sheet items posting. Yeah. Now we'll go for incorporating the adjustment items. This page is no more required. Now, 4 adjustments are there. Last GR and capital reserve already incorporated, so only 3 adjustments are there. The assets were realized as under bank. Debtors, put the tick mark here. We realized 24,000. Stock, only 80,000 rupees. Furniture, 40, but we realized only 16. Premises, though 120, we realized only 90,000. Expenses of dissolution, here bank. Expenses, 4,000. Further creditors, 12,000 had to be met. Creditors 20, but we have to pay 32,000 rupees. There is another creditors to be met. Nothing mentioned about mortgage loan, right? That's why I told you to put the tick mark once the item sold and settled. If remaining any unsettled liabilities as well as unsold asset, it should be assumed realized at the same book value. So mortgage loan, the value being 80,000 rupees. So we have incorporated all these things. Double entry. The next entry will go to the bank account realization for the expenses, payment to the creditors and mortgage loan. 4,000, 32,000, then 80,000 rupees. And here realization, amount recovered by selling debtors, stock, furniture, premises. 24,000, 80,000, 16 and 90,000. Hope now you'll be able to understand. Yeah.
Stock 60,000.
Stock?
60,000.
Okay. Okay, 60,000. Now, you are required to drop realization account, partners capital account and cash account assuming Venus became insolvent. Nothing was realized from his private estate. Apply the principles laid down in Garner-Murray rule. So, who is insolvent? Venus is insolvent. Okay. So, come on, tally the realization account and find out balance here. I think 4,16,000. 4,16,000. Balance being 1,26,000. Am I right? Should be shared to the partners N, J, V and P in their P&L ratio 3:2:1:1. 54,000 36,000, 18,000, 18,000. Okay. The realization loss should be transferred to the partner's capital account, debit side. Realization loss. N 54,000, 36,000, 18,000, 18,000. Hope now you'll be able to understand all these things. Two things are there. What are they? Realization loss is there. One of the partners insolvent and his balance is also negative. Come on, try to solve this. Now I'm going to tally this. First, you have to close the books of insolvent partners, 28,000. 28,000. 18,000 will be the value here. V has to bring 18,000 rupees, but V is insolvent totally. V is insolvent totally. If he is insolvent, what happens? Two things to be done. One is solvent partner should bring the cash for the realization loss. Next being this loss, insolvent partners' deficiency will be shared by the solvent partners in their capital ratio. Two things are incorporated. The rest will be the easy. Now, first, bank. Bank is for what? Realization expenses. Should be brought in by NJP. How much is that? 54, 36 and 18. 54,000, 36,000, 18,000. Here, capital. N, J and P. How much they bring in? 1,08,000. Am I right? All the three. This is for realization loss. So when the partner is insolvent and realization account shows loss, the solvent partner should bring the cash for the realization loss. Step 2. As V is not able to bring this loss, it should be adjusted by the solvent partners in their capital ratio. Capital ratio means capital could be prepared. Capital account can be prepared under two methods. Fixed capital and fluctuating capital. In case of fixed capital, you can take directly the capital given in the fixed account. In case of fluctuating, what you have to do? Do all the adjustments related to the accumulated transferring the accumulated profits and losses and any other assets and changes happening in the assets and liabilities will also be incorporated. Leaving the realization. Okay, up to this. Okay, clear? Leaving the realization, what is the balance of their capital? Tell me. N J P. Forget about V. What about the capital? Balance they have 160, 12 negative. And GR and CR 30, 20 and 10. Finally 130, 80, minus 2. Minus 2 can be removed out. Now the final positive capital balance being only 13:8 between N and J. This will be shared by N and J in their capital ratio 13:8. So you share that 18,000 to these two, then 11,143 for N, 6,857 for J. Right. This is for V's capital. Hope now V's loss is shared by N and J using their capital ratio as per Gardner's assessment. Now finish up tallying, the rest will be as usual. Only these 2 points. Solvent partners should bring the cash for the realization loss. Second, insolvent partners' deficiency will be shared by the solvent partners using their capital ratio. If the capital ratio being fixed capital, no problem, you can take directly from the fixed capital balance. In case of fluctuating capital, all the accumulated profits and losses should also be added. Any revaluation resource and reversal surplus and losses is there now, that should also be adjusted, except the realization loss. The ultimate balance is the capital ratio to be taken here. Okay. Now finish up telling this. I think it is 1,84,000. 1,84,000. Bank. What is the amount payable to bank? 1,18,857. Similarly for Jupiter, 1,16,000. 1,16,000. Now what is the value here? 73,143. And P case 30,000. 30,000. There's a shortage. Now he has to bring in 2,000 rupees. He is not insolvent, so he can bring this money. So here P is capital 2,000. Here capital for N and J. For N we have to pay 1,18,857. For J 73,143 should be payable. Now finish up telling the capital bank account. Hope it will be agreeing with 3,08,000. 3,08,000. Clear? Question number 4. Dissolution of firm's single partner insolvent case. But here in realization we get the profit. If we get the profit in realization, you can apply the second judgment only. First judgment is irrelevant. Assuming that the realization of the assets and discharge of the liabilities are carried out immediately, show cash account, realization account, and partners capital account. B Dev is insolvent. Okay, B Dev is insolvent. Let's start. Realization account, capital account, and cash and bank account. Finish off posting the assets and liabilities. First of all, we'll try to finish up the liabilities first. Assets first. And who are the partners we have? The partners have sharing profits and losses in the ratio of 4:4:1:1. Okay. Now, for the partners, F Kapil, S Kapil, R Dev, and B Dev, the other side is given, B Dev. 4 partners. F Kapil, S Kapil, R Dev and B Dev. The ratio being 4 is to 1 is to 1. Now, capital account and current accounts are there. Capital account and current accounts are there. In capital account, balance 2 lakhs, 2 lakhs, are they 1 lakh, be they dash. Current account, okay. You can club these two accounts as we are planning to close. You can club these two. Current account also be posted in the current account itself. 50,000, 1,50,000. If you prepare separately, finally the current account will be incorporated or integrated with the capital account only. And 1,10,000. And we have been given the loan. NBFC loan 5 lakhs. And we have the current liabilities 70,000 rupees. 70,000 rupees. In case of asset, land 50,000, building 2.5 lakhs, office equipment 1,25,000. Computers, I post all the assets one after one. Computers 70,000. Stock 3 lakhs. Debtors 4 lakhs. Stock 3 lakhs. Bank 75,000. Balance in bank 75,000. Other current asset 22,600. Current account bank B Dev, sorry. Current account B Dev 87,400. So I have posted all the balance sheet items. Now, A and B, these two adjustments are going to be incorporated. The following assets are to be adjusted to the extent indicated with respect to the book values. Assume then realized. Bank. Land realized being 200%. 200% is 1 lakh. Computers only 70%, 49,000, 70 into 70%. Stock 90%, 2,70,000 rupees. Building 120%, 2.5 lakhs into 120% being 3 lakhs is the amount realized. Debtors only 95%, 2,85,000. Am I right? 5% not realized. 5% not realized. 2,70,000. Yeah. Come on, tell me. Debtors here is right. Okay. 4 lakhs and on that 95%. Okay. 3,80,000. Okay. In case of loan, the lenders are to be paid at a prepayment premium of 1%. While making the payment to the lenders, NBFC lenders, we have to pay 5% additionally. If you are cancelling ahead, you have to pay additional money, 1% extra. for the NBFC non-banking financial corporation loan from them. On repayment, 1% is also added, so 5 lakhs 5,000 you have to pay. 5 lakhs 5,000 you have to pay. Right. Then Seeth last adjustment, Seeth adjustment. B Dev is insolvent and no amount is recoverable, and his father R Dev, however, agrees to bear 50% of his deficiency. So whatever the B Dev's deficiency you have will be taken by his father R Dev 50%. This is as per the deed. First, you have to go and refer the deed. If the deed is absent, then you go and refer the act. If the act is absent, then you can go and refer the judgment. Already deed is there. 50% loss is taken by RD, and the balance of the deficiency agreed to be apportioned according to the law. What the law says. Okay. Should be shared by the solvent partners FK. Okay. F Kapil, S Kapil, and RD. Under what ratio? Capital ratio. As it's being the fixed capital, you don't need to adjust anything. So 2:1 will be the final ratio. Find out the B Dev's loss. 50% taken by R Dev. This is the deed agreement. Agreement stands first. Balance 50%. There is no agreement. There is no act also. Then we refer the judgment. Judgment says it should be shared by the solvent partners using their capital ratio. The capital ratio, it is being the fixed capital, right? So 2:1 will be followed. Clear? Before you approach for this, try to verify all the assets sold or not. Other equipments, office equipment and other current assets silent. Silent means you have to understand the same amount is recovered without any deviation from the book value. Other current assets. That's why I told you to put the tick mark here. Current liabilities also remains unticked. It is also assumed to be paid as it is 70,000 rupees. Now, double entry, it should be posted in the cash account. In the receipt side, realization account for all the assets. In the payment side, liabilities. Liabilities in total 5 lakhs 75,000. Assets total be 12 lakhs 46,600. I put the total directly. Okay. In brackets, you can write total assets. If only 2 or 3 items are there, you can write directly. Else, you can write the total value also, no problem here. Clear? Now, close the books. By closing the books, of course, we don't have loss, we have the gain, I think. 18 lakhs 16,600. 18 lakhs 16,600. 24,000 gain should be shared among all the partners in their P&L ratio. FK, SK, RD and BD. In what ratio? 4:4:1:1 ratio. 9,600, 9,600, 2,400 and 2,400. Now, realization profit only we have. So, 9,600, 9,600, 2,400, 2,400. B Dev being the insolvent, his capital account should be first closed. If I close his capital account, what is the balance you are getting? 87,400. 87,400. You get 85,000. This will be shared by FK, SK, RD. How? Out of that 85,000, there is no realization loss. If there is a realization loss, remaining three partners, FK, SK, RD should bring the realization loss in the form of cash. Out of that 85,000, deed says 50% is accepted by his father, 40 to 500. Balance 40 to 500, will be shared by the rest of the partners as per the act, which is capital ratio 2:2:1, not the P&L ratio, it's capital ratio. Share 40 to 500 in the ratio of 2:2:1. I think you'll get 17,000 rupees for F, 17. Okay, last 8,500. At the maximum RD, because of the deed, because of the act, both put together, he takes around 51,000 rupees loss of his son BD. So FK takes 17,000, charged with 17, SK charged with 17, RD 51,000. Here BD is capital. That's all. Rest of the things are very easy as usual. You close and transfer to the cash account. 2,59,600, 2,59,600, 2,42,600 bank. In case of SK, yeah, 3,59,600. Cash brought in by him being 3,42,600. In case of RD, 2,12,400. Money brought in by him is 1,61,400. Settled to them. Okay. Capital account FK, SK, RD. 2,42,600, 3,42,600, 1,61,400. Now tally the cash account, you'll get 13,21,600. 13,21,600. Clear? In this case, you don't have money to recover from any of the partners. Two things you have to do. Rest will be the same. Like number one, you have to open a new account called deficiency account. As money is not sufficient, you cannot post that in the cash account or bank account. Any amount shortage non-recoverable is named as deficiency account. Number two, liabilities account are opened separately. Okay, liabilities account are opened separately. Okay, open separate. Out of. Now come on, join with me to solve this illustration. Yes. Open the capital account. And realization account. So, realization account, capital account, cash account or bank account, New account is going to be opened, which is called deficiency account. Deficiency account. Is that okay? ABC were equal partners. Their balance sheet given here. Record the balance sheet items. Come on. For the partners. A, B, and C are the partners, sharing the profit and losses equally. Post the capital account here. Balance. A's capital being 1,60,000, C's capital being 1 lakh. And A's loan, better open A's loan account separately. All the liabilities account will be opened separately. Here, balance being 2 lakhs. And creditors, that should also be opened separately. Not posted in the realization account. Balance 10 lakhs. Now, I'm going to post the assets now. Building 4 lakhs. Machinery 4 lakhs. Furniture and fixtures 1,60,000. Stock 1,60,000. Book debts 2 lakhs. Cash and bank balance 10,000. Balance for B being negative capital 1,30,000. Record the balance sheet item. One extra point you did. Okay, which is nothing but what? Open the liabilities account separately. Because we don't have the cash, so we are not sure whether we are able to pay it to them or not. So we have to wait. Okay, once again. Next, the firm was dissolved as all the partners were declared insolvent. The assets were realized. Bank. Book debt realized less for 45%. Then 90,000 bad debt, remaining 1,10,000 realized. Building, we got only 1,60,000. And stock 1 lakh. Machinery 2 lakhs. Furniture and fixtures 40,000. and realization expenses 10,000. Now double entry in cash realization assets. How much we realized by selling the assets? Get me the total. 6,10,000 rupees. And realization for expenses 10,000 over. Now see how much cash balance we have. 6,10,000 only we have if I tally. We have to pay to the creditors, yes loan as well as partners capital and all. Definitely we don't have sufficient money. Even we cannot pay to the creditors out of the money available. In case of all partners insolvent, cross verify whether any money can be recoverable from their private estate. For A, 2.5 lakhs private estate, private liabilities 2 lakhs 50,000, nothing can be recoverable. In case of B, private assets 2 lakhs, private liability being 180, excess amount we asked him to bring inside. So we can ask him to bring. For C, 230, but private liability is more. We cannot get anything from him. Negative value skip. We are able to get around 20,000 rupees from B. So ask him to bring that 20,000 rupees as the partnership is going to be closed. Okay. The journal entry here. Here. 20,000 brought in by whom? B's capital. Here back. If the private asset is more than private liability, ask them to bring and contribute here. So we got it contributed. Clear? Now we have to pay what? Creditors, A's loan as well as ABC. These partners' capital account has any balance should be payable. In that case, you have to find out the priority of distribution. Priority of distribution. Okay, first, external debt should be paid. Outsiders debt. Next, internal debt. Internal debt is nothing but loan from partner. The external debt includes partner's spouse loan also. First, whatever the amount you have to use this for paying the external debt, including the partner's spouse loan. Next, partner's loan. After that, if we still have balance, then can be used for capital repayment. Here, in this illustration, what happens? Creditors being the external liability, we have to pay them first. A's loan, partner's loan, internal liability second. After paying this, if we still have surplus, then we can go for paying to the owners. Now, how much cash balance we have? 6,30,000, 6,40,000, 6,30,000 only we have. This 6,30,000 is not even sufficient to pay to the creditors. Whatever the amount available, completely used for paying the creditors only. Okay, creditors. Non-payment amount will be named as deficiency. This is called deficiency. Hope you will be now able to understand why do we open the deficiency account. 3,70,000 will fall under deficiency. You transfer here. Creditors, we cannot pay 3,70,000 rupees to the creditors. What about the A's loan? Even we cannot make the payment to the creditors, definitely we are not able to pay the money to A's loan. So the entire 2 lakhs will be considered as deficiency. Here, A's loan cannot be payable, deficiency. We say this is being the deficiency. That particular party will say bad debt. This will be the bad debt. Bad debt corresponding to the person who is not able to pay is called deficiency. And tally the realization account and find out if there is any profit loss. 13,30,000 rupees. And of course, there is a loss only. 13,30,000 rupees. Loss being 7,20,000 shared among the 3 partners A, B, C. 240 each. 2,40,000. Charged to the partners' capital account. Realization loss. 2 lakhs 40, 2 lakhs 40, 2 lakhs 40. Finally, close the capital account. Find out the difference. There is no any cash balance payable or recoverable. Whatever the difference is there, no, is called deficiency. For A, 2 lakhs 40, 2 lakhs 40, 80,000 we get here is called deficiency. Similarly, in case of B, 3 lakhs 70, 3 lakhs 70. After subtracting 20, 3 lakhs 50 is deficiency. In case of B, 2 lakhs 40, 2 lakhs 40. After subtracting 1 lakh 40,000 is deficiency. You transfer the deficiency as it is in the credit side, should be posted in the debit side of the deficiency. A, B, C. 80,000, 3 lakhs 50,000, 1 lakh 40,000. Now finish up tallying this. It gets tallied. Usually under this model, deficiency account will get closed. Will get closed. Is that clear? So with that, all the dissolution concept, single lot concept is over. So piecemeal will continue.